Hello everyone, welcome back. In the previous two episodes, we adjusted the core names in our capital rotation watch list to 4 stocks: JNJ, CME, AVAV, and ETN. Today we will do two things. First, review how the price action of ONDS, CME, AVAV, and ETN has been validated. Second, add a new name, DGX Diagnostics, to the watch list. First, the market background. AI is diverging, and capital is looking for new directions. As we discussed in the previous episode, the market has now entered a phase of divergence. AI-related stocks are no longer rising and falling together. The market has started to examine which companies can truly deliver revenue, profits, and cash flow. Against this backdrop, our watchlist framework remains unchanged. Look for 3 types of assets: infrastructure that AI capital spending cannot avoid, financial cash flow businesses that can still make money in a high volatility environment, and healthcare and defense companies with inelastic demand and pricing power. Let us start with ONDS. When we first added it to the watch list on July 28th, the core accumulation zone we gave was $7.20 to $7.50. On July 31st, ONDS closed at $7.49. On August 3rd, ONDS opened at $7.40 and finally closed at $8.37, up 11.75% for the day. From a validation perspective, first, price validation. The low of $7.25 landed exactly within the $7.20 to $7.50 core accumulation zone we gave, followed by a strong rebound. Second, volume validation. Trading value reached $453 million that day, with sufficient turnover. Third, catalyst validation. BlackRock disclosed a 7.2% passive stake in ONDS, and analysts gave it a strong buy rating with a 12-month price target of $19.81. But note that ONDS has already rebounded more than 11% from its low and has entered the short-term $8 to $8.50 observation zone. This level still has room relative to the previous high of $15.28, but the short-term risk of chasing higher is also increasing. Those who have already entered can take partial profits to protect gains. Those who have not entered can wait for a pullback to $8 to $8.20 that holds before considering it. Now let us look at CME. The strategy we gave in the previous episode was $260 to $263 is the first pullback observation zone, and $255 to $258 is the core support and accumulation zone. On August 3rd, CME opened at $268 and closed at $266. From a validation perspective, CME did see a slight pullback in line with our view of high-level consolidation, but the price did not fully pull back to the $260 to $263 observation zone, with the low only reaching $264. This shows that downside buying interest was stronger than expected, and the market was unwilling to give a deep pullback. Technically, CME's stock RSI is in the extreme overbought area at 100. CME's beta is only 0.27, making it a low-volatility defensive name. In the short term, it is more likely to consolidate within the $264 to $270 range. Existing holders can continue to hold, using $260 as the defensive line. Those who have not entered can wait for a low-volume pullback and stabilization near $264 before considering it. AVAV is the most fully validated of these 3 stocks. In the previous episode, the observation zone we gave was $145 to $150 for a light position watch, and $138 to $142 as the core support and accumulation zone. We also clearly stated that only an effective breakout above $155 to $160 would show that the trend has truly strengthened. On August 3rd, AVAV opened at $151.22 and closed at $159.18, up 6.57%. From a validation perspective, it was fully realized. First, the low landed precisely within the observation zone. Second, the 159.18 closing price effectively broke through the 155 to 160 confirmation zone, the trend strengthening signal we previously defined. Third, fundamentals continue to validate the move. Fourth quarter revenue increased 133% year-over-year to $641.6 million. Analysts assigned a buy rating with a 12-month price target of $226. The current issue with AVAV is this: its 52-week high is $417.86, while the current price of $159.18 is still in the early stage of a bottom rebound. After the sharp short-term rally, there is pressure from profit-taking, but the trend has already been confirmed as turning bullish. Existing holders can continue to hold using $155 as the defensive line. Those who have not entered can wait for a low-volume pullback and stabilization in the $155 to $158 range before considering it. ETN has been the most thoroughly validated. After earnings on July 31st, it surged 7.32% to $415.20. On August 3rd, it continued its strength, rising another 5.55% to $438.23 for a two-day gain of more than 13%. Volume continued to expand to 3.62 million shares, validating the view that a volume-backed post-earnings rally is true strength. ETN's Q2 revenue was $8.53 billion, up 21%, and EPS was $3.15, both beating expectations. Full-year EPS guidance was raised to $13.60. Evercore sharply raised its price target to $502, and CICC raised its target to $487. The AI data center power infrastructure thesis is being repeatedly confirmed by capital flows. In terms of execution, those already in the position can continue to hold using $410 to $415 as the defensive line. New entrants can wait for a pullback near $420 to $425 before considering it. Why focus on DGX now? First, earnings continue to beat expectations, and the company keeps raising guidance. On July 23rd, DGX released its second quarter 2026 earnings report. Revenue was $3.04 billion, up 10.2% year-over-year and 2.1% above analysts' expectations. Adjusted earnings per share were $3.12, up 19.1% year-over-year and 10.5% above expectations. More importantly, the company raised its full-year guidance again. This was the second consecutive quarter of upward guidance revisions. Full-year 2026 revenue guidance was raised from $11.78 billion to $11.90 billion to $11.95 billion to $12.05 billion. Chairman and CEO Jim Davis said, "Revenue growth of more than 10% came almost entirely from organic growth, and adjusted earnings per share grew more than 19%. Second, the business logic is clear and supported by real demand. DGX is one of the largest diagnostic information services providers in the United States. Its growth comes from several areas. Broad growth across the three channels of physicians, hospitals, and consumers, with organic requisition volume up 13%. The joint venture with Corewell Health is expected to contribute about $250 million in revenue in 2026. Double-digit growth in advanced diagnostics, including Alzheimer's blood testing, cardiometabolic testing, and endocrine testing. This is a business with real testing demand, real orders, and real cash flow. From a candlestick perspective, DGX is currently around $232, and the stock price is far above all short-term moving averages. The moving averages are in a bullish alignment, and the trend remains intact. The recent high of $240.13 is a clear resistance level. First observation zone, $222 to $225. If the stock pulls back to this area and stabilizes on lower volume, it would be an opportunity to enter with a light position. Core accumulation zone, $213 to $215. If the market gives a deeper pullback, this would be a better medium-term entry point. Stop loss line. If the stock breaks below $210 on heavy volume, it needs to be reassessed. Upside target. After a breakout above $240, watch the $245 to $250 range. DGX sits between JNJ's defensive profile and ETN's offensive profile. It has the inelastic demand attribute attributes of the healthcare sector, as well as growth validation from continued earnings beats. DGX is a choice that combines certainty and growth. In the current environment of high-level market consolidation and rapid rotation, truly valuable stocks are those that can meet three conditions: positive catalysts, financial or order validation, and sustained capital attention. ONDS, CME, AVAV, and ETN have all validated these three conditions to varying degrees. Can DGX become the next one? We will continue to track it.